Okay, so welcome to another video. This video is going to be a bit lengthy, and the reason is because of the topic, market structure. So this one topic that if you fully understand it, trading is going to be a lot easy, right? So let's start from the basics. So ideally, when price push up like this, create highs and lows, we assume and we know that the market is bullish, okay? Same thing when price is pushing down, we look at the trend and we say the market is bearish. So there are some certain elements that will qualify this to be a bullish market, and also certain elements that will qualify this to be a bearish market. Okay, this is something that I want to really understand, right? Because this is just the foundation of your technical analysis. Once you have a clear understanding of how this works, trading is going to be a lot much easier for you, right? So the first thing we'll notice is market creates a low, market creates a high. Now, this first move doesn't really give us any direction to say, okay, yes, this market is bullish or not, right? Because the first thing we want to say is that movement to the upside, which is like an impulsive movement, right? An impulse movement. And then a corrective movement is when price is dropping against the original direction of the first leg, right? And that's what we see here. But then again, if this drop doesn't go below the previous low, it means that there's a possibility market prices want to increase, all right? Now, if market prices are increasing, there's only one way to know that, yes, market's actually bullish, and that's when we have this high taken out and the market creates a new high. Now, in that case and in that narrative, we understand that this previous high could act as support for newer prices coming up, and then we'll see market continue in that direction, creating new highs and new lows. So now let's talk about like the basics understanding of market structures, right? So if I was to map that out, I'll have something like this. Price was dropping, selling, creating highs and lows. But in this case, because it's selling, there's something we would call it. It's creating lower highs and lower lows, right? Because this low in this case is not as high as the previous one. Then so we have like a bearish market become bullish again, and then we have a another direction. All right. So first off, what we do see here is our highs, our lows, right? Lower high, lower low. The reason this is a lower high is because market creates a high that's previously lower than the previous high that was created. We'll have another one, lower low, lower high, lower low, lower high. So these are like the basics. These are information that you should be aware of already. But then again, if you are not aware of this, the best analogy of this is I call it trends and flats, right? So trends is the impulsive move, flats are the corrective move, right? Now flats could be correcting upward, correcting downward, correcting sideward, right? The reason for this is because most times you might see high and the market does this, go back. You don't really see high, drop, and then continue back to the upside. Because most persons think that, every time there's going to be an impulsive leg, there will be a retracing leg to the downside if the market is bullish. And then if the market is bearish, they think that, when they see that there's going to be a corrective leg back up, right? It doesn't really work like that majority of the time. So you have to know how to gauge it. Now, in structure, there's something we call internal and external structure. Now, these levels you see here are the external structure, right? External structure is telling me that this market is bullish. Does it mean I can't sell? Of course not, right? I can sell if I'm looking at various time frames. For example, if this is spotted on the 4 hours, right? I could get in on sale on 12 minutes, on 10 minutes, right? Does it mean I'm trading against the trend? Yes, which is called counter trend trading. But the good thing is you can also profit from it if you have a clear understanding of what you're doing, right? So we'll talk about substructures, we'll talk about minor structures, we're going to talk about swing highs and swing lows, right? So let's start with swing highs and swing lows. So there are cases where market will create a high like this, and this is low, right? And the market start correcting itself back down. And then from correcting itself downward, market start to range, right? Market is trading between this high and between this low. So this low is acting as a swing low. Now, for us to understand if the market is going to be bullish, we need to take out the previous swing high and then create another high. Now, we'll then look at the lowest part of this range, and that will be our swing low. All right. So mark that as our swing low. And then what do we expect? We expect market to continue trading between this range. So swing highs and swing lows are like a certain price range that we can trade with. We could spot this on the daily, on the 4 hours, on the 8 hours time frame, and then step down to lower time frames to understand, okay, what is the market likely doing? Okay, so if I was to properly mark this out, what I just said, and to make you understand that it's quite easy to understand, we have market move like this, create highs, and then you start thinking, is the market changing trend? Because you're seeing multiple pullbacks, all right? And then you see market start going back to the upside up until the moment it takes out that high, right? That was created before. So in this case, this is our swing low, all right? Understand this to be our swing low. One moment. Let me just put the text. Okay, that's the swing low spotted at that level. And then this also will be the swing high up until the moment it is broken. So as long as it's not broken, it's still a valid level. Now, the moment this swing high is broken, what do we notice? We notice that market creates a new swing high, right? And trades within this level before pushing back to the upside. So basically take this up again. That's a swing high. And then we'll focus on the lowest part of this corrective movement that came to the downside. And this is what we'll notice. We'll notice that this is the lowest part. And because that's the lowest part, that also is acting as our next swing low. Now you notice how market trades between swing lows to swing highs like that. And then we're able to get in on trades. Now you could always use your fib retracement to get in on trades, right? And then you see price come back into our 71, 75, 79%. But these are just ideas you could use. Market would not really print in this manner, right? So now let's talk about substructures and minor structures. So they're quite important. Now, the first thing I want you to understand is substructures are opposing structure, right? So if market is bullish, substructures will be bearish. So the bearish movement back to the downside are what substructures, because it's going against the actual direction of the market. The minor structure is when price regain its direction, right? And the market start pushing back to the upside, just as you would expect, like this, right? So meaning these are the substructures that were created. We have the lower high, lower low, lower low, lower high, lower low, lower high, lower low, lower high. Now, the moment lower high is created and creates a low, then this low fails to print another lower high, we can't really be sure market is going to continue downwards. So market moves in 3 phases, right? Phase 1, phase 2, phase 3. Now, I want to understand one thing. In a bearish narrative, every break of this low give you confirmation that yes, sellers are still strong in the market. This simply means that for every movement to the downside and then opposing direction to the upside, for sellers to still be in dominance, supply needs to be respected and demands need to be filling, right? Now, this demand here is what we'll call targeted lows, right? Because this is a bearish example, right? Targeted lows are like points whereby we expect market to take out price at that level. Now, for a bullish market, we have phase 1, phase 2, phase 3, correct? Now, this is our targeted high, because if price is going to continue, demand should be respected and supply should be filling. Now, I think when it comes to like market structure, most persons think, oh, it's quite complex, but it's not. It's very, very easy. Now, you could integrate a lot of concepts into market structure. You could integrate your supply and demand. You could integrate your liquidity and all that, because if I was to talk about liquidity then, the targeted highs can act as external liquidity, which is like a buy side liquidity, and then market sweeps it, breaks it, continues higher. Now, another major important thing when it comes to market structure is break of structure. In my case, I call it a shift, right? So basically, it's the change. Like I said, we have phase 1, phase 2, phase 3. Now, structure continues to the upside because we are seeing markets becoming bullish. So in a case whereby if we're coming from a bearish narrative, this is going to be our shift. Okay, this is going to be our shift. And the reason this is the shift is because markets broke the previous highs and created a new high, right? Now let's have a simple example whereby market was actually buying and then market starts selling, creating lower prices. So now, when this happened, we can't say this is a shift. The only information that validates this break to the downside, remember this is our higher low, right? Higher low, higher low, higher low, because these lows are printing what? New highs every single time. We can only validate this as a shift or a break of structure if it prints a lower high, right? And market start pulling back down. Now, the moment this is done, we now understand that yes, the market is bearish. Now, if that doesn't happen, I can't really say the market is what? Bearish. But the moment I have that break, I understand fully well that this is my shift, which is my market structure shift or a break of structure, no matter how you want to call it. But you get the idea, right? So it's quite easy to trade market structure. You just need to have a proper understanding of what the market does, how the market is going to pull back, levels to watch out for if prices are not going the right way and stuff like that. You get what I mean? So, like I said, market moves in 3 phases, right? Phase 1, phase 2, phase 3. So let's have a look at this. What we see here is a simple example of what I've been trying to say. Look at the highs. Now this is a bullish trend. If I was to flip that, that's a bearish trend, creating highs and lows. Now every time a new high is created, you want to watch out for the new low, right? Now I want you to understand one thing, which is that for a trend and flat, market is going to trend, market is going to create flats. It could be ranges, and then market will continue higher. You want to look at the best possible levels to buy from. There might be a demand hidden around this first impulsive leg, right below all this area, because sometimes if it's too obvious, everybody wants to buy from this certain level, there could be a trap, right? The market does what? Take out everybody before actually buying. So there are a lot of concepts, like I said earlier on, that you could incorporate into this. Now let's have a look at gold, the actual chart. Let's see what the market is doing. Okay, so if I was to bring this up, now I've marked this out from a certain period of time. So the first thing I want to see here is market is trending to the upside, right? And because price is trending, we want to follow the direction. Okay, so let me come back to the 3 phase, print this level, right? So this first is our low 1. Right, let me introduce this concept to you guys. So this is our first low, right? The first low that was spotted. And now this is important because when it creates low 1, it creates the first high, correct? We see that. And then it creates low 2, right? And then we have the second high. This basically is a trending market to the upside. Now, if the market was changing direction, right? Let's say it was first bullish, then we had this happen. It has given us a confirmation of the first high, right? This is the first low in terms of the change of that direction. And then it gives the next high, which is this time around is lower. So, but the moment I see low 1, high 2, and low 2, it has given me confirmation that yes, trend has actually changed using the idea of what 3-phase trend, right? So we'll have the first high. This is the low that generates the first high. Low 2 generates the next high. Market has actually given us a shift at this level. And because of that, I want to understand that yes, market has actually changed its trend. Right? It's quite easy to understand. So let's go back to the chart. Now, the first thing we want to see here is market is breaking every high is created. And that's because market is bullish. And if market is bullish, that's what is expected to happen. So we have our swing low, we have our swing high. Market trades within this level until it is broken to the upside. The moment that is done, we have a clear understanding that, oh, price is likely to continue higher. So keep looking for buys. Now, market will always want to come back to demand, respect demand, like I said, and then every supply created will be failing. Now, these supplies are acting as what? Targeted highs, like I've spotted before. And I've said this before, targeted highs. We have price coming back into this side to grab liquidity and take it off, right? Then we have our swing lows. These are protected lows, right? As long as the lows are protected, there's clear indication that yes, market will continue higher. And most cases, if you don't understand actual structure, you might take unnecessary losses. And then most times you might be dwelling too much on lower time frame, ignoring that on higher time frame, there's a trend. And then you think market is just consolidating or ranging, and then you start taking unnecessary losses. Now, there are some critical market conditions that will not be favorable for you to just mark it out like this, right? If you're to look at GBP USD at the moment, and then you say that GBP USD has been ranging, So if I was to show you that GBP USD, it has been ranging for a certain period of time, you will not want to see, you won't see something like this, like I just did. So let's just look at that a bit. Now, what do you see? You see that this is a flat market, right? Market has been printing series of flats. Now, if you're marking a whole higher highs and lows, you see that every time you have a new high, you have a new low, then you could get higher highs and low, right? But then again, market is trending, because if you look at the higher picture, like the daily time frame, market is actually trending to the upside. So every pullback you're seeing is acting as a substructure, and then market retaining the actual direction becomes the minor structure, which is quite important for you to know, right? In this case, what we do see is that market prints low, low 1, high 1, low 2, high 3. I'm able to use that concept to define direction. Once I have that in mind, I know that, okay, this has been printed. First low, first high, second low, second high. Structure has been defined to be bullish. Same thing for bearish market, right? First high, first low, second high, second low. Structure has been defined to be bearish, right? These are things I look out for. Now, if we look at that in this current context, first low, first high, second low, once it prints a second high and then takes out this level, right? I know that, yes, this market is now what? Bearish. So I'm only going to assume the market direction has changed when this high actually pushes price lower. And then by what you're saying, you notice that there's a little bit of flat that is changing to the downside, right? Now this flat, price has broken out of the flat to the downside, and this right now is acting as a swing high. This is acting as a swing low. So before we can actually give a full statement to say, yes, market is now trending upward or trending downward, we need to see price break above aggressively to the upside or break below. Breaking below means I'll be expecting price to come into all these previous demand level that were left untapped, right? So I think supply demand, that's going to be another video another time whenever I feel like doing it. But then again, just to have a full understanding of what I'm trying to say, right? It's quite easy. Structure is not difficult to understand. You just have to understand that in cases, there are going to be flats and there are going to be trends. Now, understanding the trends, understanding when the flat starts, is what will keep you from unnecessary losses. So if we're coming back to the gold we were looking at previously, what we do see here is that, let's continue. We have a market pushing back to the upside, like I stated. And then this is our shift. Why is this the shift? The moment this high was printed and then we had this low, that high generated a low, right? But this low failed to generate another high that will take out the low, all right? So what do we see? We see price push up to the upside. Now, going up is not actually what validates it as a shift. Like I stated before, what validates this as a shift is the fact that this low was never taken out and then it printed a new low, right? Which in this case is higher low before market breaks this level. We see that break and see price pull back into this level again and then push back to the upside. Now, most of you might ask, well, it didn't really come to a demand level. Of course, but you could use your fib to always get entries, right? Your fib could always give you nice entries, and then you're able to leverage on that, because if you're plotting your fib and then you're using your basic 50% or 61.8, that level is actually mitigated. You have 50%, and you see the market actually did what? Mitigate 50%, right? Tapped into it and then bounced. So that's just the idea behind that. That's like a 50% retracement. Market comes back into a discount. So in this case, we have what we call premium and discount, right? So premium is above, you are willing to sell at a higher price. Discount is below, you want to buy at a lower price. Now, every time market creates the three-phase scenario, you want to be careful that you're on the right side. You want to first define the trend, like I said. Understand that, okay, is this your first low? And is this your first high? These are levels that will make you understand the overall trend, okay? Because once you understand this, trading becomes easier. The structure becomes easy to identify, right? Most persons have issues with structure. Say, I don't really understand the structure of the market. How can I read the price to know that, yes, this market is bullish and this market is bearish, right? So I've basically given you the secret, the three-phase pattern, right? Know your first low, your first high, your second low, and your second high. That way, you are able to understand that, yes, this structure is bullish. Now, what we see here, market continue to the upside up until this moment whereby a new low is created, generates a high, right? Now, we have this high. Now, we're asking, it has this low printed this high, then we had another low that failed to take out that high. So this high here is actually what printed this low, and then we have a shift. The reason why I didn't take this level as a shift is because this high, I needed a confirmation. Now, the momentum it used to print this high was quite low. Now, most time it could be something like this. Market just want to do a small pullback and then shoot back up, right? So you need valid reasons to assume that is a shift by breaking and then continue lower. It's as easy as that. Okay, it's as easy as that. So let's just clear those. Now, what do we see? We see the shift. This is our first low, first high. And then we'll have our next low, next high, right? Now, even though this high actually took at this level, in terms of liquidity, this is where you now mix liquidity with structure, right? Market grabbed liquidity and sold. But now, failure to take out this low gives you indication that market is changing its trend again. And what happens? Trend became bullish again, right? So it's something that, you have to have a very smart way of understanding when trend is changing. All right, so if we're to look at the current market price, the first one to identify is our three-phase pattern, right? So the first one is the first impulse, phase 2 is the corrective structure, which is like the substructure, and phase 3 is the next impulse. Now, in that case, what I do see here is phase 1, phase 2, phase 3. Structure is bullish, all right? Structure is bullish. So I want to keep that ideology. We can also say this phase 1, we're waiting for phase 2, and then price will continue higher. Structure is still what? Bullish. So market structure is not something that is complex. You just have to take out time to understand that, okay, how do I get in? How do I get out? Because as entry is important, exit is also important. All right. Market will create lots of impulses, lots of flats, trends, and substructures, minor structure, external and internal liquidities also are created, targeted highs and lows. So basically, that will be all for this video. Do ensure you subscribe, and more importantly, share this video with those who you know are struggling to read price the right way, so they get a clear understanding of how to utilize market structure.